Hey everyone, welcome to this review of question number 4 of the California bar exam that was administered in February of 2017. Now, I'm going to say that for this particular question, there's going to be many varying responses. Now, I got the sense that there were many vague terms and facts that needed clarity. So based on that, the responses are gonna differ. And also, if you use the facts, I think you did well, and I think that most people hit the major issues here. So just expect different responses. I think there also was a danger of people making up facts, and I think the danger was that you ran out of time. And also there was a lot of opportunities here to make extra points. But overall, the key was to be responsive and to use, of course, the facts. And let's go ahead and go to that. So let's go to question 4 and let's go to question number 1. On what legal theory can supplier reasonably seek to recover against art? So against art specifically. So they're going for a personal liability claim here. So let's see. So of course, most of you guys said pierce the veil. That's fantastic. Love it. And there's 3 elements there. And of course, we know that retail is it's a corporation. So I'm not going to get too much into that. And we have the alter ego there. Now, I do want to say that retail seems to be a closely held corporation. But either way, I think you can make arguments because again, the facts weren't clear if what exactly the bylaws were. But for closely held corporations, there's fewer formalities than, let's say, a publicly held corporation. The publicly held corporations do require an annual shareholders meeting, but for these kind of corporations, they're governed by bylaws. So you can make arguments either way. And I'm going to say that not having a meeting every year is not going to cause personal liability against art. And I do mention facts here, but I'm not going to get into that. Let's go to undercapitalization. And if you did not have these exact elements, that's fine. But I do hope you did use the facts, whatever elements you came up with. And I think many of you guys did, because there were a lot of facts that you could use for undercapitalization. So let's see. So first we have the distribution of dividends that may cause risk of insolvency. And art did not pay the shareholders every year. And I think art was very cautious in doing that, because the facts did say that sometimes a corporation did experience net profits, other times it didn't. So I think he did not create a risk of insolvency. So art, good job right there. Okay, but this is not in the discussion. Okay, let's keep going. So we're still under capitalization. So the corporation, if the corporation does not keep sufficient capital for foreseeable liabilities, and then that could cause some harm to art there. So let's see, what do we have as foreseeable liabilities? And we have 2 apparent ones. We have art's loan. So art did loan retail $50,000 years ago. We don't know how long ago, but that was enough, I think, to show that it was foreseeable, because of course the loan was due. And also supplier's liability. So supplier, what do they do there? They forwarded computers to retail, and the amount due was $10,000. And think about that amount. Okay, so when it was originally incorporated, okay, art did loan $50,000. So to owe $10,000 in for the computers, I think that's a substantial amount. And I'm not sure about the 20% there, but it is a substantial amount. And the point is that it's a foreseeable liability. So I'm going to say that under that element, under the element of undercapitalization, art's going to be held liable. But it's kind of weak though, right? Because the piercing the veil is a very serious act. So I think we need something a little bit more strong. I think we need to find that what do they say? We want to put the nail, hammer the nail in the coffin. Okay, so let's talk about now of the possibility that Art is transferring corporate assets to himself. And there seems to be a story here. And that's why I'm saying too that there were a lot of vague facts here. And we do know that Art was a majority shareholder and that Barbara was the minority shareholder. And let's look at the facts. Let's go there now and let's see if we could kind of interpret this story. So, okay, so we know that Barbara bought 20% of the stock of retail. Okay, and then after that, there was a decision on the board to buy 30% of the inventory, not the assets of XYZ, but the inventory. So there's something going on here. Something's going on. And of course, you know that XYZ was owned by Art. And then subsequently, okay, Art began taking home some of the retail's inventory without paying for it. So something happened that led to that, and the facts are not clear. But based on that information, it does seem that Art is transferring the corporation's assets to himself. So that could suggest fraud. And there was a lot of facts on this to suggest that. And I'm sure you guys also mentioned the family members. Okay, it could be a potential conflict of interest, and also that the directors, his family, voted him as the president. So it seems like they're not exercising their own judgment there. Okay, so let's keep going. We don't know where the $50,000 of inventory of the assets, where they went. The company did end up with $5,000 when it ceased to exist. Okay, so there's something going on there, but it does seem like there's fraud there. So I'm going to say that you can pierce the veil under fraud, and of course you also have the piercing of the veil under the undercapitalization element there. So the supplier can go personally after Art. Business judgment rule, if you didn't discuss that, that's fine. That applies when there's negligence or carelessness on the director's part. So Barbara versus Art. Now we're going to assume that the piercing of the veil was established here against Art. And let's go to the shareholders derivative suit. So most of you guys got this. That's great. So this is a lawsuit on behalf of the corporation. Usually it goes from the shareholder against the director. So there's two things that Barbara needs to show. She needs to show that a good faith demand against the director was made, and also that she was a contemporaneous shareholder. So let's talk about the first one here, good faith demand. So again, the facts do not tell us, they're not clear whether a demand was made. It just says, let's go to that now. It says that Barbara filed lawsuits against Retail and Art. So we don't know if that demand was made. So there was no demand made, and then the action can be dismissed. But that does not end the discussion here. Let's go and see if there's any exceptions to the demand requirement. And we do have the futility rule. And that just says that a demand can be futile. Where, for example, if the directors are the ones that are going to be sued. Okay, so there's an exception there. So I'm going to say that, yeah, that element is met. Barbara, contemporaneous shareholder. Yes, that's met. Now let's go on to the next one, the personal cause of action. And that's kind of what I'm getting at. Like it was vague, because usually they say, well, can you institute a direct cause of action or individual cause of action? But here it's personal. Okay, so I'm going to say it's a direct suit. That's what the question is trying to imply. Let's see now. So there, the plaintiff must show injury in fact, and it must be unique. And again, we don't know what the actual cause of action in that claim was alleging. We don't know that because the facts don't tell us that. Okay, so I'm going to say that, I mean, I'm not going to spend too much time there, even though I can, because you had the store that just ceased to exist, so that might involve employees there. So maybe the harm was not unique to her. But I'm going to say that it's limited facts. It's unclear whether Barbara can succeed on a personal claim against Art, but she can succeed, or she can proceed with a derivative action. That's what the question was asking. So let's go on to question number 3. So you guys see how there's so many ways you could answer this particular question. So let's go to number 3. It says if retail is forced into bankruptcy court, will Art be able to collect from retail any portion of its $50,000? Okay, so again, I'm going to say that there's more vague terms here because they mentioned the word forced. Okay, so that can suggest voluntary or involuntary bankruptcy. They don't say. Okay, and also, well, I don't want to get into whether the loans were secured or unsecured because they don't say that either. All right, but just okay, we're just gonna try to go for the major issue that's being asked here. Okay, because we don't want to waste time. So you could have two ways to proceed under this action. You could have a discharge of debts, and you could also have a liquidation. Let's go for the discharge of debts there. So Art did loan retail $50,000, and a bankruptcy order for relief can be discharged in favor of retail. So if that occurs, then Art is not gonna see those $50,000 again. Now, very briefly, showing a fraud. Of course, fraud can prevent the debt from being discharged, but we don't have that against fraud. It could be against Art, but I think retail's in the clear here, so retail can discharge the debt it owes to Art. Liquidation, and the facts that say that there were no assets. Okay, there was only cash, $5,000. So order of distribution, and I think most people got that, so this is fantastic. Hopefully everybody got this. Okay, so a corporation does have a duty to pay off its debts to the best possible extent. So we have $5,000 here that needs to be distributed. And also, for any capital contributors amount or their claim, it's going to fall subordinate to the claims of other creditors. So here we know that supplier is a creditor, and they did file a claim for $10,000, but there's only $5,000, so supplier's going to get that, and Art will take nothing from that action. So again, hope everyone passed, and wish you all the best. Until soon.